Welcome, everybody, to the Amberdata podcast, where we explore the intersections of finance, technology, and blockchain. Today, I'm super excited to have Zack Pokorny on, who's a blockchain research analyst at Galaxy Digital. And today, we're going to be diving into the entire Ethereum staking, liquid staking, and restaking landscape. So, really hot topic with somebody who's deep in the space and really an expert on this field. Zack, really excited to have you.
Yeah, appreciate you having me on, Pat.
And then one thing before we jump in, I just want to mention that none of this is financial advice. These are all our own opinions. Use this as information as you will. So I just wanted to put that out there. Neither of these are opinions of myself, of Amberdata or Galaxy Digital. So with that being said, Zack, let's dive before we dive into the whole restaking landscape, which is blown up into like this massive kind of new industry or new meta in the blockchain space. How did we get here? We started with Bitcoin, everything was proof of work. Ethereum transitions from proof of work to proof of stake, and then all these new innovations happen. Can you kind of like talk through the linear path of why restaking exists and how did we get here?
Yeah, I think it's really a game of programmability on blockchains is like really what brought us to this point. Like, as you kind of mentioned, we started with Bitcoin in 2008, 2009, kind of a blockchain with no smart contracts, no programmability. It's just, I have coins, I send them to you, you can send them back to me. And that was kind of it until we got to 2015, 2016 with Ethereum and the advent of blockchains or smart contracts, sorry. And like the programmability of value and kind of all the opportunities that you can do with that, that obviously brought in a ton of new users, a ton of people, and kind of showed us that we have massive bottlenecks around scaling and scalability, which kind of forced us into this modular roadmap. People probably heard of like Ethereum's like roll-up centric roadmap, which is more or less just a modular approach to scaling blockchains. And that kind of brought us to the world where we are today, where there are dozens, possibly hundreds to thousands of different blockchains that serve different purposes. And that's kind of where the demand comes from in terms of restaking, is all these different blockchains kind of needing economic security.
And the idea is, by using something like a restaking kind of as your core security layer, is it allows a new network to bootstrap security without having to find validators, kind of build this liquidity base of security, right? Is that the right way to think about it?
Exactly. Yeah, it kind of builds like what I kind of call it as like a unified like security blanket. It's like typically when you create a blockchain and need to bootstrap security, you're going to need your own token. You're going to have to go out and source your own validator set, and kind of everything that comes with that. So when we have hundreds of different blockchains, you have hundreds of different teams going out and forming all of these different kind of like pockets of security. And it's like actually highly inefficient, for a number of reasons, which I'm going to assume we'll eventually get into. But yeah, when you could just use Ethereum or a single asset and its network's validator set to kind of cover all of these networks.
The path to restaking really required us to have one Ethereum as proof of stake, right? So the Beacon chain currently holds roughly, like, I think it's around 30 million ETH, which is a little bit more than a quarter of the entire Ethereum supply. So effectively, the way that I guess I could think about it is of the liquid ETH, a quarter of it is being used to secure the network. Is that a fair way to kind of position it?
Yeah, exactly. When you like think of economic security and kind of staking, you just take the value of all the coins that are staked. And like the interesting caveat with this stuff is all of the security is delegated in a network's native tokens. So like it's all delegated in Ethereum, but it's actually calculated in dollars, which is kind of the interesting thing, especially as it relates to like liquid restaking,
Mm-hmm.
is like, and just restaking in general, is people are delegating assets of all different denominations, like
Right.
stable coins, LSTs, and all this other stuff. But it's all kind of valued in dollars. So that kind of creates volatility
Mm-hmm.
in network security. And I mean, that even relates to Ethereum L1. But yeah, that's correct. You could kind of think of it as stake supply times the price of whatever token it is, and that's your economic security.
And so out of the transition to proof of stake, we see about 30 million ETH locked in the beacon chain. Now, a big portion of that security that's locked came from kind of the birth of the liquid staking token. So before we even get into the restaking side, liquid staking tokens effectively became this idea where you get, you deposit one ETH and you get one liquid share of that ETH that's effectively being staked on your behalf.
Yeah, I think the interesting thing about liquid staking, especially as it relates to Ethereum, is Ethereum actually has like a bottom limit on how much ETH you need to be able to run a validator and actually stake on the network. So like it requires 32 ETH, and the majority of people don't have that. So without something like liquid staking, where people can show up with small denominations of ETH and actually delegate it, Ethereum would have struggled to kind of bootstrap the economic security component. And I mean, that kind of shows, I mean, it's also kind of skewed because Ethereum DeFi is bigger than obviously every other DeFi kind of sector across all these other networks. But I mean, you see like liquid staking just being so big on the network for that reason. And especially like relative to other like delegated proof of stake networks, which you commonly see across Cosmos. LSTs aren't huge, but you could also make the argument that there's not a whole lot of DeFi activity there, so people aren't like as incentivized to. But those networks kind of let you natively just delegate small units of
Yeah.
the
And
underlying.
the other thing that I think that not only is 32 ETH kind of like a relatively high threshold for most people to participate in validating the network. The other side of it is there's like the technical implementation of running and maintaining a node as an independent or solo operator, right? So like not only do you have this capital requirement, but you have this technical requirement. And so liquid staking tokens really found like a pretty solid product market fit within the crypto space. You have this risk-free rate of ETH yield that you can expose to, a larger pool of market participants with lower price to entry, still including a high like capital efficiency of giving you these assets to use within the broader DeFi ecosystem. And then to your point, it incentivizes broader network security. Like you're opening the floodgates for more people to help secure ETH. And I think about it from like the stablecoin perspective. Like there's a lot of competition in the stablecoin world because they found the product market fit, and it's effectively give us dollars, we'll go buy treasuries and we'll give you stuff on chain and we'll like capture the difference. And you're seeing a lot of competition in the liquid staking space for similar reasons, I think they all effectively operate more or less the same, but they take a
Yeah, and that's like kind of like one of the key differentiators of liquid staking to liquid restaking is staking just in the normal sense, no restaking is like a highly commoditized thing. Like everybody is dealing with the same assets, running the same infrastructure, completing the same job, and more or less getting the same payout, depending on like what you have implemented, which is like mostly around like MEV type stuff. But yeah, it's highly commoditized, whereas like liquid restaking, which we'll get into, is not. Like every single liquid restaking token is actually more or less a different product that returns different amounts of rewards and has like a totally different risk profile. But yeah, that idea also kind of translates over to stable coins as well. It's like we're just trying to get you stable dollar value on
Right.
chain. We're all kind of doing the same way. We're going about it the same way. It's just, is our stablecoin accepted in certain places that others are not? Like, can you do things with our stablecoin that you can't do with others? Is like really what it comes down to. But yeah, two like highly commoditized type businesses.
So where do you see the success of liquid staking tokens, not only from like the capturing yield, but in terms of like adoption? Because I think if you look at Lido, for example, they've been around the longest. They're embedded in almost every DeFi application. Like there's got to be not only it comes back to kind of like the network effect and how Lindy is your protocol, but like is that kind of another big barrier for just the liquid staking side, is getting integrated into the broader DeFi ecosystem, not just launching the protocol itself?
Yes, certainly. I mean, the utility of the underlying token is like one of the most important things at the end of the day. Like it's the reason why people want liquid representations of their staked assets. Like if they didn't care, they wouldn't need liquid staking tokens per se. But yeah, I mean, in the case of Lido and some of like the earlier like liquid staking protocols, it was also like a timing to market thing.
Right.
Like infrastructure really didn't exist. Like Ethereum had just switched over to proof of stake. Like it was a very novel thing. Nobody really knew like what it looked like. So like timing the market was another huge thing. But I think really what it comes down to is that liquid staking tokens are commoditized and can benefit from the kind of network effect that comes with that, with like very little differentiation between each of them. They
Mhm.
kind of all kind of just like feed off of each other as one and can benefit from the network effects of being a more like unified product.
Interesting. And so as that space has matured, so we've moved from, solo operators and node operators running running validators for the beacon chain, basically independently. Then liquid staking tokens kind of came out as the easiest entry for most people to capture some of that yield. And now you move into this idea of liquid restaking. So can you explain what's the difference maybe between liquid staking and liquid restaking for those who aren't familiar? And then how are people using both liquid staking and liquid restaking in kind of the restaking landscape?
Yeah, totally. So I think we could start off by just generally like outlining like what you're actually doing when you're doing both of these things. Because like the liquid component of restaking and staking is actually like quite similar. But when you deposit your assets into like a Lido type application, all you're doing is using your ETH to secure Ethereum beacon chain or like the Ethereum core protocol.
Mhm.
Whereas with liquid restaking or just restaking in general, you're depositing your assets into an application that exists on top of Ethereum to kind of use as security in other places outside of the protocol. So it's kind of like an in protocol versus out protocol type deal. Where the liquid component comes in is beacon chain deposits and restaking deposits into applications that exist on top of Ethereum are inherently discrete. Like you stick them in there, it's a dead end road. Technically, you can't do anything with them.
Mhm.
But people obviously don't want to take the opportunity cost of that, especially in bull markets when yields on chain are sky high.
Yeah.
So the liquid component just spits out a liquid representation of your discrete deposit that's in something like Eigenlayer or a beacon chain validator that you could then carry with you and go wherever you want. So yeah, it's really just staking is securing Ethereum core protocol, and restaking is using that core protocol value to secure things beyond the borders of Ethereum.
Okay. And for the restaking side of the world, I think the protocol that kind of captures most of the market attention right now is Eigenlayer. And
Yeah,
it's
biggest
something,
TVL.
yeah, there's something around I think it's around 15 billion in TVL.
Actually, I just checked before we jumped on here. They're at 20 billion TVL just in itself. I think like I actually have the values here so we can give everybody like the best understanding of like what this actually looks like. It was 20 billion TVL, and like 12% of it or 18% of it is stETH, which is just an Ethereum LST, the biggest Ethereum LST Lido issued. And then actually a healthy portion of it is just beacon chain deposits, which in my opinion is like a net beneficial kind of risk mitigating thing.
And okay, so I'm gonna, as a user, I either am running my own validator, I have liquid staking tokens or liquid restaking tokens. Now, I want to use these in the restaking landscape. So right now, kind of the flow as a user is I lock these assets in eigenlayer controlled smart contracts, and those give me access to basically resecure new networks. Is that the understanding? So I'm using Ethereum's or a derived version of exposure to Ethereum's security to stake to allow other networks to kind of bootstrap on top of Ethereum.
Yeah, exactly. And like even just kind of giving like the full stack of what that looks like you just buy vanilla unstaked ETH, you could take that to a liquid staking protocol, deposit it in there, and then at that point you're securing Ethereum beacon chain. They give you a liquid representation of that deposit that carries the same value as one Ethereum or one Ethereum plus whatever yield you might be getting in some cases. And then you can take that liquid representation and the value of it, deposit it into a restaking protocol like Eigenlayer, and then secure a bunch of other chains with the value of that liquid staking token.
Interesting. And so now that we're like crossing into the restaking landscape, so this is the idea is we've got all these assets, they're locked into to secure new networks or new applications on top of new networks. And so as assets are sitting in the eigenlayer, there's this idea that now I can, as somebody who's staking assets in eigenlayer, I can delegate my stake to, they're called quote unquote operators. Can you kind of explain uh, now that my ETH or my liquid staked ETH is an eigenlayer, what is it? What am I doing when I delegate it to an operator, and kind of what's like the next layer into that space?
Yeah, exactly. So node operators are akin to like a beacon chain Ethereum validator from a very high like fundamental level. It's just hardware and software
Hmm.
that runs other chains. But the caveat with these node operators, and it kind of feeds back into the commoditized nature of staking versus the less commoditized nature of restaking, is every single node operator is going to be running and validating a wide range of chains. They're all going to be different and they're not going to be the same.
Hmm.
So when you pick a node operator, you might be picking them based off of like reputation. Like these people have like a long track record of like doing this stuff well and being able to scale it up. But you also might be looking at it from the perspective of I just want to be yield maxing essentially, and I just want to go to the node operators that are running the highest yielding AVSs, which are just chains outside of Ethereum core protocol that are benefiting from the restaked Ethereum. So yeah, that's like the general gist of it is like you pick a node operator, they may be running any number of AVSs, they're all running different ones, and no node operator really looks the same.
Okay. And then in terms of the AVSs, the way that I'm trying to capture the way that I think about it is like those are more or less your applications or second layer chains built on top of the eigenlayer, and basically the operators are running support for those networks.
Yeah, exactly. And I think an interesting note too on like the AVS side is a lot of this stuff is middleware. So it's not
Mhm.
necessarily like you're securing like another layer one network, like
Right.
as like restaking or as they call like replicated security and interchain security in Cosmos. A lot
Mhm.
of the stuff around Eigenlayer and the Ethereum based restaking protocols is actually like middleware that connects blockchains together, like shared sequencers and data availability layers. So it's kind of servicing the glue that's pulling all of this stuff together, which I think is like an interesting kind of caveat.
Yeah, that makes a lot of sense. And I think if you look at some of the existing AVSs, I mean, there's a few primary themes that do pop up, and I think you mentioned them:
Yep.
data availability, shared sequencers. I think there's a few Oracle.
Oracles, bridges, like really like the glue that kind of brings networks together, which is just kind of like an interesting observation, I think, around this stuff.
And so from the why are people locking so much capital within this ecosystem, I think comes back to what is the expectation that people have from this growth? I mean, I think obviously we're not doing this from the goodness of our hearts. We want to see there's the idea is that there's some economic return on putting this capital to work to secure new networks. And is it outside of, I know Eigenlayers just dropped a token, but it's currently not transferable and not trading. Um, but is the idea that people are effectively thinking of this as running their own node operators for like nascent networks and saying, okay, well, I should theoretically participate in the fees in anything, any reward structures across all these ABSs. Is that kind of like
Yeah,
the
exactly. Like from the node
concept?
operator's perspective, I think most are probably thinking about it in a way that's no different than like when proof of stake got huge in like 2020, 2021, and like node operators and like the validators as a service groups were like, this technology seems promising, or like they're building something interesting. Like, let me kind of like jump on and secure that.
Mhm.
Um, but yeah, I mean, from the user perspective, I think there's a couple primary drivers. One of them is restaking is really the only big new kind of primitive thing
Mhm.
to do on chain that we have that we didn't necessarily have last cycle. And two, we've just seen a huge wave of new ways of incentivizing behavior on chain through like all these points programs and all this stuff, which is also like very novel and is proving, I think, to be effective, like for better or for worse. Like it certainly does like stoke a lot of activity, and it lets protocols kind of guide users where they want them to go. Um, but I think it also introduces a lot of mercenary capital and a lot of mercenary users at the end of the day, and like doesn't necessarily incentivize the formation of good products or sound products or just like genuine activity. But yeah, I think those are like the two drivers from like the user side of things.
And it's interesting you say that. So let me see if I can share my screen really quick, because I think one of the things, to your point, that was interesting about this is kind of to the mercenary capital standpoint is if we're using eigenlayer data, for example, to analyze like the inflows and outflows of
Yeah, and I think I mean, if you like really look around, like you'll see a lot of charts where it's like points programs in place, like token announced, every kind of like user and activity metric you could imagine just gets sent to zero.
yeah.
But where it's kind of interesting with the restaking stuff is there's like so many layers to this. You have like the core like restaking applications that are incentivizing points programs. And then you have the liquid restaking protocols on top of those that are also incentivizing points programs, but at the end of the day are just depositing value into the restaking applications at the bottom. And then you have all the AVSs that kind of live up top that haven't launched yet, are not even really talking about tokens, but people kind of just assume like that's going to be inevitable in some cases. So
Yeah.
it's like leveled incentive that just ends with all of this value kind of pooling around restaking in the end.
But it is interesting because I think to the incentive structure, I think we've come a long way from like where incentives began to align back in the early days of Ethereum to where things are now. And there's more of a long-term mindset instead of like uh basically issuing the entire supply of an asset day one. You kind of have this idea of build, release, build, release, build, release to like maintain incentives. But so one of the things, as you mentioned, you do, and I've seen this across a lot of protocols, is token incentives are announced, token launches, liquidity exits, and it's very like consistent pattern of once somebody has something to exit with, they generally take the capital because the opportunity costs are high because there's likely something else that they can use those assets for. And so when I was looking at the Eigenlayer net deposits and withdrawals and deposits. So the Eigenlayer closed deposits to just kind of like maintain risk and like allow people these deposit windows back in February of this year. They recently one launched their token and then two opened up deposits and withdrawals. And if you look at like the recent um, deposits and withdraws, my assumption was something similar, is you're going to see a net outflow because there's, your initial allocation of assets or of tokens has happened. But it's, I mean, outside of these few bars, it's not fundamentally like this massive exodus. And I think to your point, where it gets interesting is if we look at the delegation side. So these are all the people you end up restaking with, or I'm sorry, staking, delegating your liquid staked tokens to run and support these growing networks. Is if you look at the amount of assets delegated, it's about 70%. So there's actually like not a lot there's only about 30% of assets not delegated. So there shouldn't realistically be this mass exit. And I think that's a really interesting mechanism because most of the protocols or just kind of like the dApp landscape is kind of one dimensional. You have the dApp and you have its use case. And when you get the token, you can take it and go do stuff with this. But because there's like not just like the opportunity of what your assets are securing is much broader than token, A has some value that I can extract now. So I think that was like one of the more interesting things that as I was looking through this data, that kind of popped up, and I was like, dude, why are there? This is the normal kind of behavioral pattern you see on chain. So I'm curious, like, does that reflect kind of what you're seeing in this space as well, and your understanding?
Yeah, I mean, there's a number of cases where like people spent months like farming these things and then like the token launches and then everybody bails.
Hmm.
But it's just different, I think, with the restaking stuff because it's more layered
Yeah.
and there's like a lot of ways to get into it, and kind of just like the openness and nature of like how blockchains are architecturally, they were able to identify like where in the funnel were you getting in at. So like liquid restaking protocols were able to let users get eigenlayer points or farm eigenlayer while also being deposited through their platform and farming their points. So users never actually needed to withdraw or unstake from Eigenlayer to continue farming stuff, which I think is why you see kind of like the smaller, like less exaggerated decline
Yeah.
or just like withdrawals and decline in Eigenlayer TVL. But yeah, if you really look around, you'll see some pretty gnarly charts around like points farming and all that stuff.
So one of the things, and I'm curious, like how you think about it. So there's a lot of concentration, not just in these restaking platforms, but even within liquid staking tokens themselves. Like Lido is something around like I don't know what the exact number is, but they have a massive market share of this stuff. How do you think about concentration of these assets, concentration of protocols, like from a risk perspective?
Yeah, I mean, at like the Ethereum beacon chain level, like, I mean, Eigenlayer has like a huge share, obviously, but they have like 30 something node operators that they use. So I think like the question of decentralization around like Lido stake is a bit more benign than you might see. Like, while still serious, like, is probably a little bit more benign than some people let on.
Hmm.
But I mean, they've also like stepped up, and a number of other liquid staking protocols on Beacon Chain have stepped up and said like, we'll actually like cap ourselves like at this point. And like, if it were to get like bad enough to a point, like even like Ethereum like core builders could step in and kind of take measures to solve the problem. But when it comes to restaking, like there's nothing you could actually like really do at the Ethereum like base chain layer to
Right.
stop everything that's happening above it. And I mean, I'll have a report coming out on it in a couple weeks here, but I kind of talk about like what drives concentration of stake at the restaking level. And it
Mhm.
really comes down to, at least from my point of view, how many rewards you're going to be getting paid. Like if people see like there's one AVS in particular that's just like printing and is able to offer like super high yield, like I think everybody will flock to it. And it's also going to come down to who can scale the best. Like every single AVS is a different service that requires different demands from node operators,
Yeah.
which is like very difficult to scale, which is not really a thing that's present at Ethereum base chains. Everybody's just kind of doing the same thing. Like whether you run like two beacon chain validators or 200, like the job that you're doing individually with each machine is like the same thing,
Right.
which is not the case when it comes to restaking. So there may only be a couple node operators that are capable of securing every single AVS and then
Yeah.
scaling vertically. But yeah, the biggest risk is that Ethereum has spent so much time trying to figure out how to deconcentrate stake at the beacon chain level.
Right.
And now we're just going to throw this layer on top that pretty much says, yeah, this is just like another vector for concentration risk, and there's like really not much you can do about it.
Yeah, that's really
Yeah,
interesting. I never thought about it from the perspective of like the AVS and the operator relationship is to your point, like if you run one beacon chain node, you can run 1,000. And so like scaling an operation is just time and attention. It's not so much like the
like
expertise.
different responsibility, like yeah,
Exactly.
like figuring out how do I secure and run a data availability layer versus
Right.
bridge. Like some of them may be more passive, some of them may require more attention. Like some AVSs may just be too like labor intensive to keep scaling up to a certain point. So there's a cap with like how much you could actually scale. And like all that stuff like boils down to concentration risk. Because if somebody could get really good at scaling all of it, they're obviously going to be able to produce the most rewards, and then just stake is going to flock there.
And so then you have like a single delegator or a single operator with a huge portion of the delegation if they're like the most successful at running all these AVS.
Yeah, exactly.
Interesting. I haven't thought about it from that perspective, but and then so at this point in time, while there are AVSs, most of them really aren't massively adopted, used, integrated. it's still pretty nascent in the AVS landscape, correct? Is that correct?
Yeah, most of them are still being developed. Like
Yeah.
EigenDA is like a big one. I think that one might be like the farthest along. I honestly haven't spent too much time like studying the individual AVSs.
Right.
But yeah, there's none live. There's none like actually paying rewards like in real life. Like they have them running on testnet, I think paying rewards, I'm pretty sure. But yeah, there's nothing like actually like up and running
And then
like mainnet.
there's one piece that I think we haven't touched on, and I know you've done some work around this side, but the operators themselves can be exposed to reward slashing. Is that correct?
Yep, that's the risk. So like yield from nowhere comes for free. Like even at the beacon chain level, like securing Ethereum, there is slash risk, and that's like essentially the risk that you take to get paid out the Ethereum staking reward.
Mm.
So like the same like risk reward kind of dynamic exists in restaking is you delegate your assets, you're gonna get some reward stream, and then your risk for that is getting slashed.
Yeah, and I guess the trade-off is while like the implementation of it may be the same, like you're way further up on the risk curve in the restaking landscape, because just like the further away from like the base you go, you're like effectively just kind of like scaling into a higher level of risk anyway, where obviously I think people are thinking that the rewards are going to, outpace, whatever the ETH yield is at like 3% right now. And
Mhm.
so, but the mechanics of slashing are fundamentally the same when you're delegating to an operator.
Yeah, yeah, the same kind of dynamic exists. But I think the the way you kind of want to think about the amount of slashing risk you're taking is essentially like the number of AVSs that your node operator is securing.
Mhm.
Because you could delegate to a node operator that may only be securing one AVS, and then you just kind of have like beacon chain and then one AVS slash risk. Like one unit of account in restaking can be applied to any number of AVSs. And then each one you add, it just adds more risk. There's a linear relationship between number of AVSs secured and the amount of risk of like slashing or losing your funds you're taking.
That's
And some AVSs may have heightened slash risk just because the kind of thing that they perform might be different than like beacon chain. So there may be more ways you could get slashed on an AVS than there are on beacon chain or like a base layer
right.
protocol. But conversely, there could also be less. Like there could be some AVSs that like maybe you just have like one way you can get slashed, and that one way of getting slashed is like very difficult to do. So it could come across as like virtually having like quote unquote like no risk or like risk free, but
Mhm.
like the risk always exists, even if it's not like a high chance of happening.
Yeah, that makes a lot of sense. And I think from the AVS support level, like one of the obviously from like the maximizing returns, the way that I was kind of thinking about it is like, okay, my operator that I'm delegating to supports the most AVSs. So this is likely, fingers crossed, this seems like it could be the highest yielding if one of the AVSs, becomes extremely successful. But on the risk side, I hadn't thought about it from one, the implementation and operational side of maintaining kind of the infrastructure to support them. And then two, you kind of have like this concentration of risk across each of the AVSs themselves. And so now,
Yeah, like it does get interesting too, like just to kind of like feed off of the point you brought up is like node operators may not make it like abundantly clear like how they're actually doing all this. Like for all we know, some of them will be using like the same machine to secure multiple AVSs, and like they mess up on one machine and then you get slashed across like everything, including like beacon chains. So like there's also like risk in implementation, like physically how they're doing it. Like are they being diligent and running like a separate machine for like each AVS and not intertwining or like
yeah,
commingling their beacon chain validators with all the AVSs?
yeah,
Like the potential for like correlated slash risk, I think, is like pretty high, depending on kind of how node operators choose to like physically implement
yeah.
this stuff. Like the diligent ones will do what they need to do to make sure that they're not doing that. But some of them who may not be as well capitalized or have like the human capital to actually like scale and do the right thing in that way may not. So like those are like all questions that you kind of want to be asking, like how are they like physically like implementing this, and are they taking like all the preventative measures to kind of insulate themselves from getting slashed?
Yeah, that makes a lot of sense. It's super fascinating to see. And it's funny because as you said, like there hasn't been a new primitive in the space for a while. I think there's been a lot of innovation, a lot of adoption, a lot of improvements on the UI side. But in terms of like net new like crypto innovation or on-chain innovation, this has been like a really interesting one to see basically how it's playing out in real time. And so right now we've got about 15, there's about $100 billion of ETH value locked in Beacon Chain, 15 billion securing uh, or being restaked to secure the future of other applications building out. And so to see like these things couldn't have happened without all the other stuff preceding it is really, it's really cool to see where that path of like progression happened. And then on the flip side is like, what's built on top of Eigenlayer or on top of any restaking protocol. Like there's kind of like the second layer of innovation to be had on top of it too. So I think seeing where these things actually have like feasible impact in improving, you know, whether it's speed, data availability, like just in general improvements in the ecosystem will be really fascinating to see. And one of the things I know, so slashing is obviously like this risk of delegating to your operator, but slashing is not active yet. Is that correct? Isn't it something that Eigenlayer has, or the restaking protocol, at least on the Eigenlayer side, has to like initiate?
Yeah, I don't think any of them have like fully detailed like what slashing is going to look like.
Okay.
Yeah, and the Eigenlayer folks have been extremely diligent in kind of like how they think about this stuff and roll it out. Like even though they get like a fair amount of like flack, mostly around like their token launch, but they're actually like thinking about this stuff diligently and kind of rolling it out in stages. And I think the rest of the restaking sphere is kind of moving in lockstep with them on that. Which in my opinion is like a net beneficial thing. Like they're actually taking the time to make sure like everything makes sense, like well oiled, and like we could move on. But what they did do with the launch of their token was the introduction of intersubjective slashing stuff,
Mhm.
um, which kind of feeds into like what they might do in some cases of slashing, but doesn't kind of give like the full picture of like what do we do when, say, like somebody gets slashed for like downtime. Like what does that look like? So we haven't heard from them on that, but we have gotten like half of the slashing picture.
Yeah, that's super interesting. And so as this space develops, I think like obviously there's a lot of unknowns, but it seems like there's a lot of collective mind share behind seeing this idea of using a theory, like the fundamental thought of what this is allowing to do to unlock new networks and new applications on top of existing security is really interesting. Um, Before we kind of wrap up, I just wanted to ask outside of I mean, I think this landscape, and you spend so much time doing research in this area. What's your like long-term outlook on this whole category of restaking? Like, is it cautiously optimistic? Are you know, kind of neutral? What's your take on it in general?
Yeah, I think it's one of the more like fundamentally important things that we're building right now. Like we kind of hit the cap on how we could scale through like the previous model, which was mostly like integrated chains.
Mm-hmm.
So anything that pushes this idea of like modularity and scaling through modularity, I think is a fundamentally important thing
Mm-hmm.
that we should be subsidizing. Now, I think we're going to go through an era of seeing hundreds and hundreds of chains and all the middleware kind of in between them. And then we'll see like some consolidation around like, okay, we're going through this phase where smart contract apps are potentially just turning into chains like for the heck of it. But it's something that we ultimately need to experiment with to kind of get to the other side of like what this all ultimately will look like and achieve the things that kind of have brought us to this point, like decentralized systems and all of that stuff. So I think, yeah, anything that fundamentally pushes that idea forward, which restaking plays a huge part in my opinion. But yeah, I think the future on this stuff is pretty optimistic. Obviously, some risk, but that kind of just goes for everything
Yeah.
in this space and just life in general.
Yeah, exactly.
Yeah,
And then
nothing comes for free.
on the I know we talked a lot about Eigenlayer. I think that's just because where the innovation began and there's a lot of capital kind of locked up there. Where I mean, where are you seeing similar types of implementations of restaking across other networks? Is this something you expect to scale outside of this, just the EVM ecosystem into other assets?
Yeah, absolutely. I mean, it exists in the Cosmos ecosystem through replicated security, which is fundamentally similar. It's restaking, just like technically implemented differently. And then they're also experimenting with partial set security in Cosmos, which is more akin to what Eigenlayer looks like in terms of like subsets of Ethereum stake being used to secure other applications. But yeah, you're seeing it kind of all over the place. And I think we're also entering a period which like restaking just kind of represents like more generally is blockchains are going to turn to renting resources like more broadly. Like at the end of the day, all restaking is just renting economic security from another chain. It's more prevalent.
Yeah.
I think you're going to see people or chains renting liquidity. They're going to find ways to rent users. Like anything that goes into creating, bootstrapping a chain and kind of getting a DeFi ecosystem up and running that can be rented and leased, I think will be.
Yeah.
Which is like kind of what you see in the real world, right? Like younger people turn to like renting to kind of bootstrap their life at the start. And then
Right.
some of them go on to achieve like great things and can like buy a house and do whatever. I think that kind of like caterpillar to butterfly through like renting and then owning, you're going to see like in the blockchain world as well, which I think is like a pretty fascinating thing to
Yeah,
watch.
that's a really interesting way to think about it. So, Zach, I think, I mean, we covered a lot, and I really appreciate you jumping on. I think as the space develops, you and everyone at Galaxy is doing a ton of really cool research around, I mean, not just restaking, but I mean, tons of innovative applications across the crypto space. What's like the best place for them to either follow you, follow research that Galaxy is doing? Where can we plug you guys?
Yeah, absolutely. We post stuff every once in a while on Twitter at GLXY Research. And you can also find us through the Insights page on the Galaxy website, where we post stuff like from our desk specifically, and then all of the businesses across Galaxy. You could hear from asset management and all the other teams who also post like research type content as well.
Amazing. Well, Zach, that's all the questions I had. I really appreciate you covering this. I think especially as this is such a new category, having somebody who's deep expert in the space and really kind of diving into the meat and potatoes of how it's being implemented, the risks, the upsides, kind of the future of what this space is. Thank you so much again for joining.
Yeah, appreciate you having me. It was great.
Take care. Thanks.